You might notice something a little different in today's video because yes, I did get a haircut. This is not my Britney Spears moment. I'm not trying to portray I'm being crazy or anything. I have a receding hairline and I wanted to try this style. So far it's okay. I'm not super comfortable with it yet, but we'll see if that changes and see how it evolves and maybe grows out a little bit. My beard comes in a little bit more because I shaved it right before I got it on Saturday. So we'll see how things evolve. Anyways, that's enough with that. Let's get into markets because while I might not be crazy, I definitely think this market is crazy. And in my opinion, as I've said in the past couple videos, it's the biggest market dislocation I've ever seen. We obviously know there's a massive disparity between the market and the Fed. And even today, I'm listening to CNBC, and there's a debate. There's a debate around whether the Fed is going to hike in May. I don't think so. I think there's just some people who are, suffered a lot last year, are winning a lot this year, and are ignoring the fundamentals and are trapped. And I know it's easy to say about me because I'm taking losses, but here's the thing. The Fed has spoken on this issue. Susan Collins said after PCE, that even if we had a weaker jobs report, the Fed's guidance was still going to stay in place. Weak March jobs report. I don't think the March jobs report was particularly weak. I think, if anything, it was strong. And at worst, it was in line with expectations, not particularly weak. I don't think there's anything weak about a 3.5% unemployment rate. So as far as I'm aware, still strong economy, still strong job market, or at least strong job market. I don't know about the economy, but strong job market, strong labor market. And I think it's pretty much guaranteed that the Fed is going to hike in May. Let's not forget, just last week, the market was only pricing a 40% probability that the Fed was going to hike in May. Now that's up to 80%, but we're still not seeing the correct pricing in the bond market. This should continue. Obviously, that was a good thing, a good normal behavior in the morning when the markets were lower, yields were higher, and things were going as planned. But as the day continued to evolve, we saw some things get out of whack. Particularly, I'm just going to use NVIDIA Rise as an example. A stock that has deteriorating fundamentals, two pieces of deteriorating fundamentals, a red open and then a green close. We got TSMC saying they experienced their first revenue decline in several years. Samsung reporting their worst earnings since 2009, slashing production massively. People are trying to view this as like an OPEC cut, that chip producers can just cut production and be fine, that somehow this brings supply and demand into balance. Yeah, it brings supply and demand into balance, but when you have supply and demand at a higher supply and demand, and then you bring it to a lower supply and demand, you make less money. And that's exactly what's happening in these companies. Last quarter, NVIDIA reported a 20% revenue decline and a 50% earnings decline. I'm getting some Fed speak. I'll pull this up with the iPad. But anyways, the chip picture, in my opinion, is not very good. This is an area you want to be short if the stock is very expensive. So the inflation outlook is fraught with uncertainty. Fed's Williams. It is critical to comprehend that inflation dynamics are complex. This year, I expect inflation to be around 3.75. So that leads us to our next point, bonds. We want to continue this bond discussion. Bonds are finally starting to have a higher yield. I mean, 2-year below 4% didn't make any sense. The Fed has been steadfast in what they've been saying. As we said, May hike seems pretty much guaranteed based on the fundamentals. Unemployment stability has been a notable development, okay? And yields going up, and the 2-year has no reason to be at 4%, even where it is today, because the dot plot is pretty, they don't put this out as a joke. This is serious business. They put this out. They said even with a weaker March jobs report, we're sticking to the dot plot. So if the dot plot is remotely accurate, then yields should be much higher. And that's not good for tech because the banking crisis caused yields to fall precipitously, quite a bit, caused the market to price in crazy rate hikes, all this stuff. And the banking crisis has gone away. I get it. Commercial real estate might suffer a little bit. There might be some losses there, maybe, if people can't renegotiate their loans and keep those properties. But the St. Louis Fed financial stress indicators went back to below pre-SVB levels, went back below zero. So we're below normal stress now. Everything seems to be fine. We're not seeing tremendous deposit outflows, and we're seeing very low yields. So as far as I'm aware, yields need to rise to correct for their previous mistake. They made a mistake assuming the banking crisis was going to get so bad. Hopefully some banks, and actually some banks did in fact, decrease their asset holdings and increase their cash holdings. I saw this when the Fed published its data around Fed balance sheets over the weekend. So yields need to go up, and the tech rally has been largely aided by yields. So now we're going to get into a leg where yields need to increase, the market needs to adjust its expectations for the Fed, and fundamentals are deteriorating. The information we are getting, don't make no mistake, it is not good. The Samsung thing, not good. I don't understand how people are trying to spin it positive. I don't think it's going to last more than a few days. I think just bring on the next hammer, and it's going to correct. Then you've got Apple. Apple seeing 40% declines in Mac sales. I believe the computer industry overall, 29% decline in sales. It's not going to benefit chips. It's not going to benefit. This is not OPEC. Totally different picture. So, banking crisis subdued. Jobs report not weaker, which the Fed would still keep them on their path. So safe to assume that one side of the debate just isn't doing their homework or something, because it's very obvious that they're going to hike in March. So yields got to go up. And then we have declining fundamentals in tech. Yeah, I get it. The market is weird. It was normal. It seemed like things were going normal in the morning, even in the chips. But as the day went on, things just changed. So tomorrow we've got Fed member Goolsbee. My understanding is that he's the most dovish member. I've heard him speak before, most dovish member. So if he's the most dovish member, he should set the floor. And last time I heard him speak, he was more hawkish than the market. So when the most dovish member is more hawkish than the market, Houston, we got to correct. So we'll see what happens. Today's one day. I'm seeing some good positive signs, and I'm seeing some annoying signs of the same. But we're going to hope those subdue, and it's finally time for the fundamentals to take over. That's today's video. We'll see what happens. Until next time, peace out.